You know, for years, the investing playbook felt pretty simple, almost automatic. But if you've had this nagging feeling lately that the old rules just aren't working anymore, well, you're not alone. Today, we're going to dig into what's behind that feeling and break down a massive shift that's changing the entire investment landscape as we know it.
For over a decade, the golden rule was buy the dip, right? The market corrects, you buy more, and you just trust that it's going to bounce back. But what if that strategy, that one reliable move, is now what some analysts are calling mathematically dangerous? It's a wild thought that pretty much challenges everything we've been taught, and we're going to tackle it head on. So here's our game plan. First, we're going to establish how the game has changed. Then we'll dive into why that old buy the dip strategy might be a trap now. We'll also uncover this kind of hidden force that could be draining your portfolio without you even knowing it. See where the smart money is moving, and finally, we'll put together a brand new playbook for this new era.
All right, let's jump right into our first section. Look, it is so important to understand that what we're seeing right now, it isn't just a temporary storm. It's not a little dip in the road. It feels more like the road itself has completely changed direction.
And here's the absolute key takeaway. The economic models, all the assumptions that powered the markets for the last 15 years, predictable interest rates, steady growth, they're basically broken. We have entered what a lot of sources are calling a harsh new paradigm, and that needs a whole new way of thinking.
Okay, now for the idea that probably hits closest to home for a lot of us. Especially if you're someone who's been aggressively buying those dips, maybe even on margin, this next section is absolutely for you. We're going to look at the dangerous math behind this once unbeatable strategy.
To really get why the old models are failing, we have to talk about a recent and honestly kind of mind-blowing market event. It's called a 5 Sigma event. Now, to put that into perspective, an event like this should only happen once every 3.5 million days. I mean, that's once in the entire history of human civilization. It's just not supposed to happen.
So what does that mean for you? Well, when you see a 5 Sigma event, it's like a giant red flashing light telling you that the computer models, the algorithms that Wall Street depends on, are failing. They are running into a reality they were never ever programmed for. So that predictable snapback you might be waiting for, it's just not guaranteed anymore because the old rulebook has been thrown out.
And hey, it's not just the algorithms. The prices themselves are stretched to historic levels. Get this, by 18 out of 20 key metrics, the S&P 500 is considered extremely overvalued. So think about what that means. When you buy the dip, you're not actually getting a bargain. You're just buying an already overpriced asset for a little bit less. The real value just isn't there.
And this all leads us to the new expert consensus. People are no longer calling buy the dip a savvy move. They're calling it mathematically dangerous. The mix of broken models, crazy high valuations, and a weak underlying market means jumping into these corrections is a huge risk, especially if you're using leverage.
But why is there so much selling going on even when it comes to good companies? This brings us to a powerful and kind of invisible force that could be hitting your portfolio right now. It's called the denominator effect, and honestly, understanding it is the key to understanding this new market.
Let's break this down. Imagine you need to pay your rent, but all your money is tied up in, say, a classic car you can't sell quickly. What do? You go and sell your best watch, the easiest thing to turn into cash. Well, that's exactly what big funds are doing. Except instead of a watch, they're selling their best, most liquid stocks, like Apple or Microsoft.
And the scale of this problem is just staggering. We're talking about an estimated $3.8 trillion in these unsold, hard-to-sell private assets. Think of it like a giant dam holding back a massive amount of pressure that's about to spill over into the public markets.
So here's how the chain reaction works. First, those private assets are essentially frozen. Second, the funds still have bills to pay, like sending out pension checks every month. Third, to get the cash, they have to sell their best public stocks. And the result for all of us? This constant, relentless selling pressure on the market that has nothing to do with whether the companies being sold are actually good or bad.
It's really a case of selling the good to save the bad. So even if you're a long-term investor, doing everything right, maybe just dollar-cost averaging into an S&P 500 index fund, your portfolio can still get dragged down by this hidden pressure that has absolutely nothing to do with how well those companies are actually performing. It's a tough pill to swallow.
So, with all that going on, where in the world is the smart money going? The answer, it seems, is a huge pivot away from abstract ideas and toward things you can actually touch. It's a pivot to physical reality.
The shift in thinking here is pretty profound.
We're moving from a focus on abstract growth to tangible physical stuff, from speculative software to the actual hardware that makes AI work. And this is a big one. We're moving from just buying safe company names to focusing on assets that have safe prices, prices that actually make sense in today's economy. I absolutely love this quote. Trading dreams for shovels. It's like the old gold rush. Instead of betting on which prospector is going to strike it rich, the smart money was on selling them the shovels. In the world of AI, that means investing in the essential memory chips and hardware. Because it doesn't matter which AI company wins, they all need the physical hardware to run.
So who are the winners in this new world? Well, we're seeing companies tied to energy security, defense, and hard infrastructure. We've got the AI memory chip makers we just talked about, and maybe most importantly, companies with real pricing power, the ability to pass rising costs onto their customers. Think about a company like FedEx, which was able to pass on higher fuel costs. That's a huge advantage now.
All right, let's wrap this all up with an actionable playbook. If the old rules are broken and the old strategies are dangerous, what should you actually be watching now? Let's build a new dashboard for this new era. Instead of the old signals, try focusing on these. Diesel and jet fuel prices, because they impact the real economy way faster than crude oil does. The 2-year Treasury yield. Think of it as an early warning system for stagflation, that ugly mix of a slow economy and high inflation. And that concept we just talked about, pricing power, a company's ability to protect its profits, is now a huge sign of strength.
But there's one final, really provocative idea that's coming out of all this. It suggests that the most valuable, the most scarce asset in this new world, it's not what you think. It's not oil, it's not gold, it's not even microchips. It's human, physical, and mental health. A multi-trillion-dollar wellness economy is literally rising up to deal with the cost of our digital age. The burnout, the screen overload, the loneliness. The ability to just withstand the pressure of this new environment is becoming the ultimate competitive advantage.
And that leaves us with a final thought to chew on. In a world where old strategies are failing and markets are under this constant pressure, maybe the most valuable investment you can make isn't in a stock at all. Maybe the one asset that lets you navigate this harsh new world is your own well-being. So is your health the ultimate performing asset? It's something to think about. Thanks for tuning in.